You bought the breakout. Price reversed, ran your stop, then went exactly where you thought it would, without you. You weren't unlucky, you were standing on the wrong side of the model. Because market makers don't chase price, they build it. The market maker model is the blueprint for an entire move, not where to enter, the whole journey, start to finish. There are two versions, the sell model and the buy model. They're mirror images of each other, as I'm sure you could imagine. Learn one and you've already learned the other. So let's build the shape. Every model has one job, move price from one pool of liquidity to another. Liquidity is just resting orders, stop losses. Think of it as fuel. And it sits in predictable spots, above old highs, below old lows, equal highs. Market makers push price toward that fuel, use it to fill their orders, then turn it around. So every move has a destination. That destination is the draw on liquidity. The model tells you that destination, which is the exact part most traders never figure out. Let's start with the sell model. Picture a mountain, up one slope, down the other. Part 1, the original consolidation. Price coils in a range. This is the staging area. Part 2, the climb. Price rallies, making higher steps, looking strong and bullish. But that climb is bait. Every step up stacks more fuel and lures in breakout buyers. Retail piles in long, certain it's a trend. They're the fuel, not the driver, aka liquidity. Part 3, the peak. Price reaches an expensive zone, the premium, where smart money wants to sell. It sweeps the highs, grabs the fuel above, and then it turns. This is the turn, the smart money reversal. The turn snaps structure downward and generally leaves a gap behind it. That gap is the tell. Part 4, delivery. Price now steps down the other slope, making lower highs all the way down. And the target was never the top, it was the lows where it all started. Mountain complete. Now flip everything. The buy model is the same story upside down. Picture a valley. Same staging area, price coils in its original consolidation. Then the drop. Price falls, making lower steps, looking weak and bearish. That drop, again, is the bait. It stacks fuel below and lures breakout sellers short. Price reaches a cheap zone, aka the discount, where smart money wants to buy. It sweeps the lows, grabs the fuel below, and turns up. The turn mirrored. Structure breaks upward, leaving a gap behind, and price climbs out of the other slope. Target? The highs where it all began. The valley is complete. Same engine, opposite direction. Here's the key to actually using it. The turn splits the whole model into two halves, before the turn and after the turn. Before the turn is the trap, that first leg, the engineering, the manipulation. Whether it climbs or drops, it's where retail ends up getting caught. After the turn is the trade. The reversal is confirmed and price is finally delivering toward its target. And the two halves mirror each other. The levels built before the turn get respected after it. That gap that the turn left behind, price often comes back to it after the turn, then keeps delivering. That's where you want to enter. So you stop chasing that first leg before the turn and you start trading the move after it, where smart money has already piled in. Before you trust either model, run 3 checks. Miss one and it's not the model. 1. The higher time frame structure already agrees with your direction. 2. The draw on liquidity points the same way. There's a clear destination to aim at. 3. The turn happens at a real level, and you're not buying or selling into a premium. A real level could be relative equal lows or highs, depending on the direction. Maybe it's a higher time frame fair value gap. Regardless, the turn is happening at a relevant spot, not in the middle of nowhere. All 3 and you've got a model. Miss any and it's just a shape that you wanted to see. So the whole thing in one breath. The sell model is a mountain, the buy model is a valley. Before the turn traps you, after the turn pays you. And the move always ends at liquidity. Find the destination and you've found the trade. It's not a pattern, it's a map. Learn to read it and you stop being the liquidity. If this video was helpful, please consider liking and subscribing. Thank you very much.